Hi there, James Rowe here, presenter of the Which Cars podcast. Join me and the Which Cars team as we cover the biggest motoring stories, including our exclusive research into car reliability.
When 5 to 9-year-old cars break down, they spend on average 4 days off the road. New to 4-year-old cars spend 4.8 days off the road. Now that might not seem like much in the general scheme of things, but that's a 20% difference. And that could be the difference, for example, if you break down on a Monday afternoon between getting your car back for the weekend or having to wait into the next week to having it repaired.
Should you buy a used car rather than a new one?
Unless you're desperate to get a car in exactly the colour or specification you want, there are plenty of low mileage used cars on the market with significant discounts on their new price. And if they're from a brand, say like Toyota or MG, which offer long warranties, then it can actually be quite a good option buying used because you'll still have that manufacturer cover behind you.
And why are car headlights so bright nowadays?
Car manufacturers want to make life easier for the driver, so they add these LED or laser headlights that illuminate the road ahead like never before, which is great if you're driving a car. Not so great if you're on the receiving end coming the other way.
To listen to the full podcast, head to which.co.uk/cars podcast. You have to be a Which member to listen, but you can get a membership for 50% off the usual price. All the details are on that page, which.co.uk/cars podcast.
Welcome to the Which Money Podcast, your weekly hit of money news and personal finance hacks to help make you better off. I'm your host, Lucia Ariano, and here's what's coming up this week.
Most people, in fact, the vast majority of people don't actually have to pay it.
Getting married can be really, really tax efficient. Now, it's not the most romantic reason to put question and propose to eliminate your IHT bill.
This week, we're covering inheritance tax. It's something that's become a very hot topic in recent months following the government's proposals to make some changes to how it works, which will lead to more people facing a bill. It's often understandably an emotive subject, but it's also a complex one with lots of rules that determine how and when inheritance tax is charged. So to help us better understand what inheritance tax is, how it works, and how you can potentially avoid it, joining us today, we have Which Money editor Jenny Ross. Hello, Jenny.
Hello, great to be here as always.
Thank you for joining us. And also Director of Public Policy at AJ Bell and another familiar voice to our regular listeners, Tom Selby.
Hello.
Hi, Tom. Thank you both so much for joining us today. Well, first then, can we start off? Jenny, maybe can you explain the basics of how inheritance tax works in the UK?
Sure, although before we get into the details, I just wanted to stress quite an important fact about inheritance tax that I think sometimes can get lost in discussions about it because, as you say, Lucia, it is quite an emotive subject. People have strong views on it. And that is that most people, in fact, the vast majority of people don't actually have to pay it. Now, if you look at the latest figures from HMRC, and they are around, 2 or 3 years old now, but they show that it's only around 4% of deaths that actually resulted in a bill. So very much in the minority. And yes, it's true that that figure is set to rise. And I'm sure we'll talk more about why that is later. But even then, even when that figure does rise, it will remain a relatively small proportion. So I'm conscious that, there may well be listeners out there who have been really worried about it, but actually when they look into the details, they find that they don't really need to be. So yeah, I thought I'd say that up front as a bit of important context, but yeah, I'll get into the reason for why a relatively small proportion of people pay it now and sort of the nitty gritty of the rules. It is because inheritance tax is only charged on estates above a certain value. So everyone in the UK has an inheritance tax-free allowance that's worth £325,000. And that is known in technical jargon as the nil rate band. Then there is actually an extra allowance that's worth £175,000 if you are leaving your main home to your children or to your grandchildren. And again, for the jargon, if you really want to know, that's called the main residence nil rate band. So those two allowances combined, that gives you up to £500,000 in total that you can pass on before a penny is due in inheritance tax. Now, there's an extra layer to this as well. If you are married or in a civil partnership, your spouse, if they outlive you, they can inherit your unused allowances on top of theirs. So if you add all that together, your two allowances plus theirs, assuming that you're passing on your main home to kids or grandkids. That ultimately means that couples can pass on up to £1 million completely tax-free. And then another sub point here, those allowances have remained at the same level for quite a number of years now. And the Chancellor recently confirmed that they're going to be frozen all the way up until at least 2030. And that is one of the reasons that more people will end up paying inheritance tax, because obviously house prices haven't remained frozen over that period. They've been rising, pushing more people above those thresholds. But still, I'd come back to my original point, many estates, even in the years to come, will not be worth enough to exceed those tax-free allowances.
And Jenny, I'm pleased you came back round to that point again, because I was wondering, if it impacts such a small proportion of the population, why are so many people worried about it?
Yeah, it's a good question, because even though the number of people that it affects is relatively small, where it does affect you and where you do end up with a bill, that bill can potentially be pretty big. And that's because of the high headline rate that's applied, that is 40%. So yeah, that is a big reason behind some of the anxiety and anger, really, in some cases, that a lot of people can feel about inheritance tax. But as I've just explained with the rules there, that 40% doesn't apply to everything you own. It only applies to the chunk of your estate that is above the tax-free thresholds. So quite often people worry unnecessarily because of confusion about the way that the tax actually works in practice, which is completely understandable, really, because as we've sort of got a sense of, it's not really straightforward.
Well, should we talk a bit then about what exactly is included as part of your so-called estate? Tom, can you talk us through it?
Yeah, sure. So it's most stuff. So most assets that you hold in life when you die will count towards inheritance tax and will count towards your estate for inheritance tax purposes. So things like property, so residential or commercial properties owned outright or jointly, that will count towards your estate. Money, so cash in bank accounts, savings, any investments that you've got, so stocks and shares. Personal possessions as well, so not just investments and assets like property, but things like jewelry, furniture, cars, any valuable personal belongings you got will all go into the pot when HMRC is deciding whether or not you've got any inheritance tax to pay. Certain life insurance payouts as well, where they're not held in trust, that will count towards your estate for IHT purposes. Certain gifts, and I think we'll go and talk about those in a bit more detail later on, but certain gifts will also count towards your estate. Crucially, at the moment, if you have any unspent pensions, they don't count towards your estate for IHT purposes, but that is proposed to be changing in a couple of years' time.
And that's the big change that a lot of people are talking about, isn't it? So bringing pensions into the inheritance tax net. So could you explain a bit more then how this could impact people in practice?
So quite significantly, we and others believe. So the wage bill has been quite strongly opposed, not to the idea of taxing unspent pensions on death, but the idea of using inheritance tax to achieve that policy aim. So lots of people who are listening to this will be aware, and just based on the explanation that Jenny gave at the top there and the number of assets that are involved, IHT and the settling of IHT bills can be an incredibly time-consuming, complicated process already without adding pensions to the mix. So you've got lots of different people involved, potentially lots of different beneficiaries involved. You've got solicitors involved, different assets involved in different places. We've already seen a significant increase in the number of people for whom the probate process, or the time it takes to pay your IHT, lasts for over a year. So that's increased by about 130% over the last 3 years already. Now, adding unspent pensions to the mix is only going to lead to further significant delays and extra administrative costs, both for individuals and providers and I think this is really important, what is an emotionally difficult time for lots of people. So often it will be a loved one has just died. Dealing with this administration is difficult enough as it is. You add something as complicated and as involved as pensions to the mix, and that's going to get much, much more difficult, particularly when you think, and we talked about this on the podcast before, lots of people have multiple different pensions in their retirement and will have multiple different pensions when they die as well. So each of those different pensions will need to speak to the personal representative once they identify who that personal representative is, in order to do things like apportioning the nil rate bands that Jenny talked about at the start, and deciding whether or not there's an inheritance tax bill to pay. So loads of complexities in that IHT process. And our view is that actually the cost and the time, the delays to that process are simply not worth it. And actually there are simpler ways for the government to achieve what it's trying to achieve here, which is ultimately to raise revenue by taxing unspent pensions on death.
I do wonder as well, as you were talking there, has the government detailed whether or not you would pay inheritance tax if you died before or after, a certain age? Have they considered that into the net?
So this is another one of the challenges. So it will be IHT under their proposals from April 2027 will be chargeable from any age, but there'll be a difference in the overall tax burden you face depending on if the person who dies before age 75 or after age 75. Now, before you ask, there's no particular reason why age 75 is this cut-off point. It's just something that's existed in the pension rules for a long time. But if the person dies before age 75, it will just, it could still be significant, but it will just be IHT to pay. If the person dies after age 75, then a nominated beneficiary or beneficiaries will have to pay not just IHT, but they'll have to pay income tax as well. So where a nominated beneficiary is receiving money as an inheritance and they're higher income taxpayer, for example, then their overall tax rate on that inherited pension, when you take into account IHT, assuming that's payable, and as Jenny said, that won't always be the case, and income tax, you're talking about marginal tax rates of over 60%. So you've both got these significant delays in paying money to people and also really high marginal tax rates that will be applied essentially at random, depending on whether or not the person dies before age 75 or after age 75. So it's a slightly weird, complicated system that leads to strange results as well as delays in paying money to beneficiaries. And so our view, and the view of lots of other firms, by the way, in the industry as well, is that rather than adding more assets to this already complicated IHT world, the government should look at different, simpler ways to achieve what they're trying to achieve.
Gosh, you can really see how this is such an emotive topic. Well, Tom, bringing pensions into the scope isn't the only inheritance tax related change announced in the October's budget. Now, farmers in particular haven't been happy with the proposed new rules, and we've seen regular protests from farmers and NFU members in recent months. Why are they concerned?
Yeah, to be clear, you're not going to see AJ Bell or other pension scheme administrators marching on Whitehall or driving tractors to Whitehall as a result of the tax on death that's been applied to pensions, although it is a significant issue. So the issue around farmers is we talk about IHT there being a really emotive issue that's accelerated and accentuated when you think about farmers. So at the moment, farmers benefit from agricultural property relief and business property relief. Now, what that means essentially is that farms and assets can be passed on to beneficiaries completely tax-free. So they sit on their own, essentially, in the IHT system as being something that can be passed on completely tax-free to beneficiaries. Now, those reliefs exist and were designed to prevent the breakup of farms upon the death of the owner. So lots of farms are family-run businesses. Often they're very asset rich, but they'll be quite cash poor, so there won't be a huge amount of income coming through. And in terms of maintaining those farms and maintaining food security in the UK, the argument is that those reliefs need to exist in order for those farms to be passed on as family businesses down the generations without facing potentially crippling inheritance tax bills. So that's the argument from the farmers' side. Now, the government has proposed capping those reliefs, so that those agricultural property reliefs and business property reliefs at £1 million. That'll mean that any farm assets above that value will be subject to IHT. So below that value, no IHT, above that value subject to IHT, although at a reduced rate. So not at 40%, but half that rate of 20%. 8%. Now, the government would say that this is a fairness argument and it's a revenue-raising argument as well in what are clearly quite difficult fiscal times for Rachel Reeves. So they've argued that some farmland has been used by people and bought up by people to avoid inheritance tax, but not for the primary use of farming and the traditional use of farming in that sense. The argument against, and the reason why there's been those really vociferous protests in Westminster and in other parts of the country as well, is because those family-run businesses say, actually, this is going to make it really difficult, if not impossible, for me to pass on the farm as it is and all the assets down the generations. If we pay a tax bill that runs into the tens of thousands of pounds, actually, we don't have the money to do that, and we'll either have to split up the farm or sell it off altogether. So that's why an emotional issue like IHT has become even more emotional when it comes to the farming industry, because many in the farming industry argue that that ability to pass on property and assets tax-free is absolutely essential to the continuing of the farming industry in the UK.
And, we said that there have been regular protests. Do you think it's likely that the government could make a U-turn on any of these changes?
We'll have to wait and see. One would have thought that if a U-turn was coming, that we would have seen it by now. Certainly on the issue of inheritance tax and farming. Now, the spring statement that's coming in March isn't supposed to be a budget type event. You might have expected that if it was, that would be the point in time at which they might look to make changes. It's possible in relation to farming that they could look to try to ease the burden in some way. There's clearly a significant amount of political pressure from the government on that. On pensions and IHT, AJ Bell and various other firms in the sector have put forward what we believe to be constructive proposals to try and achieve the same policy aim, but in a simpler way. So, for example, by using the income tax system or applying a flat rate of tax to pensions on death, possibly with a tax-free amount. So we believe on the pensions front, there are simpler administrative ways to achieve what the government wants to achieve. But I think that key word that you use there is U-turn. It's difficult politically for any government to U-turn on something, even where, in the case of IHT and pensions, what we're saying is we're trying to come up with a solution here that delivers the same amount of money to you and the policy aim of taxing pensions on death, but in a simpler way. So now they've decided to go down the IHT route. The battle is trying to convince them to do something different without them being fearful of looking politically weak, essentially, by changing on something. Now that's frustrating, and you'd hope that wouldn't drive policy decisions, but I think it'd be naive to think that isn't a consideration for any politician in government.
Well, I think then we need to talk about how those affected can reduce or even avoid inheritance, their tax bill altogether. We'll be back after a quick break with that.
With so many sales on these days, how do you know when you've seen a good deal? We make it easier by trawling through the deals for you to find genuinely good prices on genuinely good products, all packaged up into a free monthly newsletter. Using internal pricing data and our own market knowledge, we keep an eye on price changes and let you know whether a product is at its cheapest point. From bargains on TVs to discounts on laptops, the products we share have all been put under the Which microscope, meaning we only recommend deals on items we know work well. Our expert advice cuts through the noise to share reductions and reviews which we think will interest you. So make sure you sign up for our brand new Deals newsletter to help you grab the genuine bargains. Just head to which.co.uk/WP_deals. That's which.co.uk/WP_deals.
Welcome back to the show. So then, if you were thinking of passing on your pension to loved ones, is it time to reconsider?
I mean, quite possibly, if you are concerned that the value of your estate is in danger of exceeding those tax-free thresholds, and your family could end up with a bill. I mean, it's certainly the case that this change is likely to be quite a big shift in the way that people treat pensions or just consider them in the context of their estate planning, because up until now pensions have been, this exemption from inheritance tax for pensions has made them really attractive as a way of passing on wealth tax-free. So, in some cases, it will have encouraged people to try and keep their pot as untouched as they can, take money that they need to live on, but ultimately try and keep some left over so that they can pass it on to loved ones without any worry about inheritance tax. I mean, there are potentially some tax implications, as Tom's explained. If you die over the age of 75, your beneficiary will currently have to pay income tax at their normal rate at the moment, and that will remain the case even after the inheritance tax change from 2027. So yeah, what you could see then, or now in anticipation of that change, is if people just thinking, okay, well, I don't need to protect this money anymore. Let me just make the most of it while I have it. Spend more on themselves in retirement, give more money away. You can see a change in the way that people choose to access their money at retirement as well. So lots of projections that annuities are going to grow in popularity, because the fact that with many types of annuity, payments stop when you die. That's no longer going to be seen as a big drawback, because ultimately it's money that won't count towards your estate and be potentially liable for inheritance tax. So yeah, there'll be quite a big shift now. Pensions will no longer be this sort of precious, protected product. But I guess that comes with other considerations as well. You might see people spending too much of their pension money because they're so anxious about it tipping them over inheritance tax thresholds. So ultimately, if you are concerned, I think I just caution against any rash decisions. Ultimately, speaking to a financial advisor and just thinking about pensions in the context of your entire estate and all of your options in terms of sort of tax-free gifts and things is really the most sensible way forward.
Yeah, I'd absolutely agree with that, Jenny. I think the key message here is not to make any panicked decisions. So firstly, as Jenny mentioned at the top, most people actually won't be subject to inheritance tax. Lots of people think they are subject to it, but actually find when it comes down to it that it isn't a consideration. So that's the first thing. And the second thing, while we don't know whether or not the government will change tack on this, ultimately we don't have any final proposals or final rules here yet. So if you're taking a financial decision today to spend your pension or to gift your pension to a loved one to avoid inheritance tax, actually we don't have the final rules yet. So it's possible that things will change as we move down the line. And the final point, and it's a slightly depressing and grim point, but some people will die between now and April 2027. So if you are, in ill health, for example, and you think you might die between now and April 2027, or if you're simply a bit older, then your beneficiaries will benefit from the inheritance tax system as it exists today. So it'll still be possible to pass on your pension completely tax-free if you die before age 75, or your beneficiaries will just be subject to income tax if you die after age 75. So for some people, it's obviously a personal decision. I agree, financial advice, absolutely key, because this is really, really complicated, but I wouldn't be rushing to make a decision now until we've got at least a bit more certainty about exactly how this is going to work in practice.
And I suppose some of the good news, it seems odd to talk about good news after that final point there. But the good news is that that there are legitimate ways of reducing or even avoiding your inheritance tax bill altogether, aren't there? We've mentioned gifting quite a few times throughout the show today. So can you tell us a bit more about that and also charity donations?
Yeah, this is a really important point, actually. The fact that you can reduce the tax bill your loved ones could face or avoid one altogether by giving money away now in your lifetime. And actually, there are no plans to change the sort of tax-free gifting rules that currently exist. So yeah, that's the one thing to note when you are giving money away, is that there are limits to how much you can give away completely tax-free. So we can run through those now. First up, you've got what's known as your main allowance. So each year you can give away up to £3,000 completely tax-free. That can be split between however many people you like, and you can carry forward any unused allowance to the next tax year, but not beyond that. So £3,000 per year. You've also got the ability to make small gifts of up to £250 per person, as long as that's not the same person that you've used your £3,000 allowance on. There's an additional allowance in the case of weddings. So you can give up to £1,000 as a gift to any couples getting married without that ever becoming subject to inheritance tax. And the limit is higher if you're giving away money to relatives. Money away to relatives who are getting married. So £2,500 to your grandchildren and up to £5,000 to your children. There's also a really important gifting rule. It doesn't often get talked about a lot, but more and more people are cottoning on to, called gifts out of income. So this is an interesting one because unlike those allowances I just ran through, there is technically no limit. But crucially, to count in this category, the gifts must be made out of what's called surplus income. So basically, they can't have any impact on your standard of living. You can't be compromising your own lifestyle in order to give money away to others. And those gifts must also be made out of what is called normal expenditure and paid on a regular basis. So there are a couple of useful examples that HMRC gives on its website for what might fall into this category. That could be things like paying rent for your child, or giving financial support for an elderly relative. So basically, there's a pattern of giving. It's a regular payment made, at frequent time intervals. So that's a good one to know about. You also mentioned donations to charity each year. And yeah, that's absolutely right. Any money you leave to a charity registered in the UK will be free of inheritance tax. And actually, if you leave more than 10% of your taxable estate to a charity in your will, there's an additional benefit, which is the rate of inheritance tax that's charged on the remainder of your taxable estate will fall from 40%, the headline rate, down to 36%.
And what about money you give away that isn't covered by the gifting allowance? How is that taxed?
Well, any gift that you make that falls outside those tax-free allowances that I've run through, they are what called in the jargon potentially exempt transfers. So essentially what that means is they might end up falling out of your estate for inheritance tax purposes and not being taxed, but only if you live for at least 7 years after you give that money away. If you die within 7 years, that gift will still be treated as part of your estate for inheritance tax purposes, but it won't necessarily incur the headline inheritance tax rate of 40%. So yeah, welcome to the wildly complicated world of inheritance tax rules. There's basically a sliding step scale that can apply in those cases. So if you die within, I think it's within 3 years, the 40% could still apply. If you live 6 years after the making the gift, but not quite the 7, then the rate will drop to 8%. But final important point to make actually on these potentially exempt transfers is that actually in reality most gifts that fall into that category don't end up being taxable, and that is because the £325,000 inheritance tax allowance, the nil rate bound, is allocated first of all to those gifts that you make within 7 years of your death before the rest of the estate. But yeah, once you've given away, say you've given away more than 325k, then anyone who gets a gift from you, in the 7 years before your death potentially will have to pay inheritance tax. So yeah, it does all get really complicated there. And ultimately figuring out the gifts that you've made and whether or not they become taxable, that will become a job for your executive, for the people administering your estate after your death. So it can get really tricksy.
There are so many layers to this, aren't there? With so many little details in each one. Well, before we start wrapping up or thinking about wrapping up today, if anyone listening, if they're worried that even after taking advantage of tax-free gifting for their loved ones will end up facing an inheritance tax bill, is there anything you can do to make it easier for your loved ones to manage this?
Really, ultimately it comes down to good record keeping. I think I would say that will go a long way. As I said, it is the job of the executor to track down all of the details of your estate once you've gone. That includes information of any gifts that could be taxable. That might involve going through bank statements, talking to family members, checking any written records, just trying to piece everything together. And as Tom says, obviously that's going to get a lot more complicated when pensions are brought into the mix. So yeah, if you have left really thorough, clear, complete records and you've told your executors where to find them, then that is going to make their life a lot easier. There's no set way to do this, but I think a helpful thing to bear in mind is that there is a form that HMRC needs executors to complete, and that's called IHT 403, which you can find on the gov.uk website. So if you sort of familiarise yourself with that and you sort of get in the headspace of an executor and understand the types of information that they'll need to provide to HMRC, then you can do a lot of the legwork and the preparation yourself. But also just to note, you don't need to worry about keeping any records of gifts that are covered by your tax-free allowances. They will remain completely tax-free, and so they sort of don't need to be brought into the picture as far as HMRC is concerned.
Tom, you were smiling when Jenny mentioned that form.
I was smiling at just the level of complexity that exists and the catchy name of that form. I thought they were those are really good and useful points, Jenny. I think record keeping absolutely crucial. I agree. Keeping your will and your nominated beneficiaries in relation to your pension up to date, really, really important. That's something that we find quite often is actually that people's nominated beneficiaries regarding their pension, actually, it turns out, aren't the people who they might have wanted the money to go to when they die. So they may have remarried, for example, or they may have had kids, or something may have changed in their life circumstances and they haven't updated the form. So all of that can really delay the paying out of money on death. So making sure your nominations and your will's up to date, really important. One other top tip, if you're in a long-term relationship and you aren't married at the moment, then getting married can be really, really tax efficient. Now, it's not the most romantic reason to put the question. Again.
With Valentine's Day coming up.
Exactly. Exactly. Propose to reduce to eliminate your IHT bill. But the reality is that spousal exemption, so the fact that if you die and any money that's passed to your spouse or your civil partner is completely free of IHT. So for some people, they may have just, for various different reasons, may have decided that they don't want to get married. You can get married extremely cheaply. It doesn't have to change anything in your life. And actually, you could save yourself a really, really significant chunk of cash. So not particularly romantic as Valentine's Day approaches, but something to think about if you are concerned about IHT.
Absolutely. And I feel like we've come to quite a natural conclusion of some really useful points to take away here. But is there any final advice, from this huge minefield of stuff that you'd like to leave our listeners with today?
I'd probably just reiterate some of the points that we've already made around not rushing into any decisions, not changing anything drastically with your finances in view of the recent announcements. As we've made clear, those rules aren't in place right now, and you might be making changes unnecessarily or that will adversely affect you in other ways without sort of considering the full picture. So take a beat, speak to a financial advisor if you really are concerned. And ultimately, it's just well worth familiarising yourself with those rules. We've tried to simplify them as far as possible, but ultimately they are complicated. But that's all the more reason that you should sort of try and get to grips with them. And first of all, establish whether this really is something you and your family are going to need to worry about or not.
I think those are all really good points from Jenny. I'd add it's the kind of thing that people don't want to think about naturally, death. Actually, a lot of the administration problems that come at death for your loved ones, for your nominated beneficiaries, happen exactly because people just put this off and don't want to think about it happening. And then there are all sorts of uncertainties when it comes to paying any assets over to your nominated beneficiaries. So try to think about it as soon as you can. Try to make sure that you've got all the right people nominated for things. And as Jenny said, that really important point, don't panic about it and don't let the fear of IHT drive all of the decisions you're necessarily making, particularly for those who actually IHT might be a fear, but might be something in lots of circumstances won't actually have any impact at all. So something to consider, but don't let that be the main driving force behind all the financial decisions that you're making.
Some really useful points there, and you've done an amazing job at simplifying what is a crazy complex topic. So thank you both so much for joining us today.
Thank you.
Thanks.
Well, a huge thank you again to Jenny and Tom for coming on the show today, and to you for listening to this week's episode of the Which Money podcast. If you enjoyed today's show, please do hit subscribe to make sure you catch our new episodes as soon as they drop. For daily money news and advice, you can find us on social media at Which Money and online at which.co.uk/money. And we also have a free money newsletter, which is delivered to your inbox every Monday. To sign up, visit which.co.uk/money newsletter. This episode of the Which Money podcast was presented by me, Lucia Ariano, produced by James Rowe, and produced and edited by John Weeks.
Saving for retirement can feel daunting. The same goes for managing your money once you've stopped working. That's why we've created an 8-week newsletter series breaking down what you need to consider, both pre and post-retirement, into bite-sized chunks. If you sign up to our free retirement newsletters, for 8 weeks we'll send you an email full of expert guidance to help you take control of your retirement planning and give you the confidence to make smart decisions. We'll help you get to grips with your pension, teach you how to boost your income, and explain more about care options. It doesn't matter when you sign up either. Your 8 weeks of advice will start whenever you sign up. So what are you waiting for? Head to which.co.uk/retirement newsletters, all one word, to get up to speed on everything you need to know for retirement.